I'm going to tell you about a tax benefit that the IRS literally built into the law specifically for homeowners that can put hundreds of thousands of dollars back in your pocket completely tax-free. Every single year, we are talking about Section 121 capital gains exclusion. And if you own a home and you are going through a divorce in New York, this might be the most expensive piece of information you will hear all year. When a married couple sells their primary home, the IRS allows them to exclude up to $500,000 in profit of capital gains tax. $500,000 completely tax-free. But once you are divorced, that number drops to $250,000 per person. Sounds like the same thing, right? It is not the same thing. And the difference between getting this right and getting it wrong would cost you anywhere from tens of thousands to hundreds of thousands of dollars, depending on how much your home is actually appreciated for. White Plains, New York, and Westchester County, where home values have climbed significantly over the past decade. This is not a hypothetical. This is real money, your money, and I want to make sure you keep it. I'm Mike Marcus, a divorce real estate specialist in White Plains, New York. Before we talk about how to protect yourself from capital gains tax, let me make sure we all know what we are talking about. Because capital gains sounds like Wall Street language, and this is actually pretty simple. Capital gain is the profit you make when you sell an asset for more than you paid for it. Simple. If you bought a piece of art for $10,000 and you sold it for $40,000, you made a $30,000 capital gain from it. With real estate, the same principle applies. If you and your spouse bought your home for $400,000 and you are selling it today for $900,000, you made a $500,000 profit. That profit is a capital gain. Now, without the exclusion, the federal government would want a percentage of the $500,000. Depending on your income, the long-term capital gains tax rate is 0%, 15%, or 20%. For most homeowners in Westchester, we are talking about 15 to 20% range. 15% of $500,000 is $75,000. 20% of $500,000 is $100,000. That's a six-figure tax bill on money you made from your own home. That's what we are trying to protect you from. And great news is that Congress knew this was a burden on homeowners and created a specific exclusion to shield you from it. That's Section 121 of the Internal Revenue Code. Section 121 exclusion actually works. I'm gonna give you the rules and then walk you through the math with real Westchester County, New York style example. The 3 rules to qualify. Rule number 1, ownership test. You must have owned the home for at least 2 of the last 5 years before the sale. Rule number 2, use test. You must have used the home as your primary residence for at least 2 of the last 5 years. Rule number 3, frequency test. You haven't used this exclusion on another home sale in the past 2 years. Meet those 3 requirements and you will qualify. And if you are married and are filing jointly, the exclusion doubles to $500,000. Now, let me show you why this matters so much in a divorce. Here's a real world example. I'm going to call this couple David and Lisa, not real names. David and Lisa bought their home in White Plains in 2014 for $600,000. Today, after years of Westchester County appreciation, that home is worth $1.1 million. They have owned it and lived in it for over 10 years. They meet all 3 rules. Here's the math if they sell it while married. So the sales price is $1.1 million. The purchase price basis is $600,000. Capital gains is $500,000. Married exclusion is $500,000. Guess what? Taxable gain, 0. Tax owed, 0. You keep $500,000. Who wouldn't want that? 0 taxes. They walked away with the full profit. Now, here's the math. If they wait until after the divorce is finalized and Lisa sells as a single filer, sales price $1.1 million, purchase price basis $600,000, capital gain $500,000, single exclusion $250,000. Taxable gain, $250,000. Federal taxes in between 15 to 20%, $37,500, or $500,000 in between that range. New York State, 8.8%, $22,000. Potential tax bill, $59,000 to $72,000. Same house, same sale, potentially $60,000 to $72,000 and more taxes because of the timing. That's not a small number. That's a down payment on a new home. That's 2 years of college tuition. That is money that belongs to you. And timing determines whether you keep it or give it to the government. So now that you understand what the exclusion is, let me tell you how divorcing couples accidentally walked away from it. Because the timing of when you sell relative to when your divorce is finalized is everything. Trap number 1, waiting too long to sell. The divorce process in New York can take anywhere from several months to a few years. I've seen contested divorces drag on for 3, sometimes 4 years. And during that time, the house just sits. Both spouses waiting, fighting, and the clock is just ticking. Remember the use test. You need to have lived in the home as your primary residence for 2 of the last 5 years. If one spouse moves out early during the divorce process and years pass before the house sells, that spouse may no longer meet the use test, which means they may not qualify for their share of exclusion at all. 523. Special rules exist for divorce situations. If a spouse is granted use of the home under a divorce instrument, the time the other spouse owns the home may count towards the use test for that spouse. Consult with a CPA. This is nuanced. Make sure you consult with a CPA. Trap number 2, selling after the divorce is final as a single filer. This one I already showed you in the math, but I want to make sure it really lands. Once the divorce is final and you file as a single, each person only gets $250,000 in exclusion. If the combined gain exceeds $500,000, and in Westchester, it easily can, you are leaving real money on the table. The solution, if possible, and if both parties agree, sell a home before the divorce finalized. While you are still married legally, while you can still file jointly and claim the full $500,000 exclusion together, then split the proceeds as a part of the settlement. I know what you're thinking. Mike, we can barely be in the same room. I get it. You want us to coordinate the sale of the house? Yes, I do. Because the math demands it. And this is actually one of the most valuable things a divorce real estate specialist does. I act as the neutral professional who manages the sale so both parties don't have to interact more than necessary. You don't have to agree on everything. You just have to agree on the goal. Keep more money. Trap number 3, moving out too early and losing the use test. If you move out of your marital home, specifically before the sale happens, you may disqualify yourself from the exclusion entirely. The IRS has specific rules around this. And there are some protective provisions for divorces, but they are nuanced, they have conditions, and they require the right paperwork in your divorce agreement. This is not a DIY situation. You need your attorney and your CPA talking to each other, and ideally talking to me, before anyone moves out. While we're talking about capital gains, I want to give you one more tool that most people overlook entirely, and that's the concept of adjusted cost basis. Remember, capital gains tax is calculated on profits. Your profit is the difference between what you sold the house for and what you paid for it. The amount you paid for it is called your cost basis. But here's what most people don't realize. Your cost basis isn't just the original purchase price. You can add certain costs to it, which reduces your taxable gain. Things that can increase your cost basis: capital improvements, a new roof, kitchen remodel, additions, new HVAC systems, finished basements. These are permanent improvements that add value to the property. Certain closing costs from when you purchased, title fees, recording fees, legal fees paid at closing. Certain selling costs, real estate commissions, attorney fees at closing. transfer tax. Let me show you how this changes the numbers. Going back to David and Lisa, let's say over the years they spent $80,000 on improvements. New kitchen, new roof, finished basement. Original purchase price, $600,000. Capital improvements, $80,000. Adjusted cost basis, $680,000. Sales price, $1.1 million. Adjusted basis, $680,000. Actual capital gain, $420,000. Married exclusion, $500,000. Taxable gain, $0. But documenting their improvements, David and Lisa reduced their taxable gain from $500,000 to $420,000, which in this case is fully covered by the married exclusion anyway. But in a scenario where the gain exceeds the exclusion, every dollar added to the cost basis is a dollar that doesn't get taxed. Keep every receipt, every permit, every invoice for work done on your home. This documentation is money. Quick but important. Because we are in New York, and New York has its own opinion about your capital gains, the federal section 121 exclusion applies to your federal tax return. But New York State also taxes capital gains as ordinary income. And New York's income tax rates go up to approximately 10.9%. New York does follow the federal exclusion for the sale of primary residence. So if you qualify for the federal exclusion and your gain is fully excluded federally, New York will genuinely follow suit. But if you have a taxable gain above the exclusion, New York wants their share on top of what the federal government takes. So in our example, if there were a $250,000 taxable gain, after the single filer exclusion, you'll probably owe federal capital gains tax plus New York state income tax that same $250,000. That's a meaningful additional hit. This is another reason why timing and strategy matters enormously, and why your CPA needs to be part of the conversation from the beginning, not just at the tax time after the sale. Look, I know tax law isn't exactly cocktail party conversations, but I need you to understand why I care so much about the specific topic. In Westchester County, homes are expensive. They're appreciated significantly. People who bought 10, 15, 20 years ago are sitting on enormous gains. And when a divorce forces a sale, that gain gets exposed. The people who navigate this well, the ones who walk away with the most money, are the ones who plan for the moment, who had the right conversations with the right people at the right time, who knew about the exclusion before they signed anything. The people who get hurt are the ones who didn't know, who made decisions based on emotion or speed or just wanted it to be over with, who found out about the tax bill after the closing check was already cashed. I'm not here to scare you. I'm here to make sure you are the first kind of person, not the second. I'll tell you this, one of the most valuable things I do for my clients isn't finding them a buyer or negotiating a contract. It's sitting down with them early before any decisions are made and walking through exactly what we talked about today. Because the right timing and a strategy on a $900,000 home sale can literally save you $50,000 to $100,000 in taxes. That's tremendous. That's worth one conversation, I promise you. Here's what I need you to take away from this episode, if you ain't take away anything else. Number one, the Section 121 exclusion gives married couples up to $500,000 in tax-free profit from a home sale. Single filers only get $250,000. The difference can be enormous, and timing determines which one you get. Number two, selling before the divorce is finalized while you're still legally married may allow you to claim the full $500,000 exclusion together. This needs to be part of your divorce strategy, not an afterthought, please. Number three, pull together your records. Every improvement you made to that home, every kitchen renovation, every new roof, every finished basement can increase your cost basis and reduce your taxable gain. Find the receipts. Number four, get your CPA involved now, not after the sale. And make sure your attorney, your CPA, and your real estate specialist are all talking to each other, because the tax strategy and the legal strategy need to be moving together. If you're in White Plains, New York, or Westchester County surrounding area, and you want to sit down and actually run these numbers for your specific situation, reach out to me. That's what I do. I love going through these numbers early so you don't have to worry about this in your future. And if this video helped you, share it. You know, somebody that may possibly need the information. Somebody in your circle needs to hear this before they make an expensive mistake they didn't even know. Drop your questions below. I read every comment and I answer anything that I can. I'm Mike Marcus. Your money belongs to you. Let's make sure it stays that way. And listen, whatever you do, make sure nobody ruin your day. I'm gonna leave you on that note.